This is the MTPredictor weekly update for November 7th. Well, we got the Fed announcement and the midterm elections out of the way last week. We also had the QE2, the Fed announcement on the QE2 last week. We've gotten that out of the way. And in a nutshell, the Fed said it is going to buy $600 billion worth of long-term treasuries basically by the end of June. The interest rates are still, basically 0 to a quarter percent. Said the recovery is disappointingly slow, yet the market continues higher. So there's kind of a disengaged situation we have between what's going on in the economy, I think, in the market here. And you can call it market manipulation. There is what they call a plunge protection team that was created after the crash of '87 during the Reagan administration, that consisted of the president, Treasury Secretary, the Fed chairman, the chairman of the SEC, and the CFT Commission chairman, Commodity Futures Trading chairman. And one of the early precursors to the plunge protection team was created by a former Fed governor, Robert Heller. And after the crash of '87, he had said everybody's attention was tightly focused on containing the damage and preventing a spread of the financial disruptions throughout the financial system. He said, don't forget that at the time we were also dealing with a severe savings and loan crisis and almost 200 bank failures per year. Without swift supportive action on behalf of the Fed, the stock market crash could well have been the straw that broke the back of an already weak camel. Well, if that doesn't sound like what we're dealing with today, I don't know what does. But clearly we've got some intervention in this market. And in fact, if you go back to August, Alan Greenspan was on Meet the Press and made some interesting comments. He was asked about the importance of the Dow, and Greenspan, in a nutshell, said, he didn't know where the stock market was going to go. He said, but I will say this, that if it continues higher, this will do more to stimulate the economy than anything we've been talking about today or anything anybody else was talking about. So clearly they're aware of the importance, in their belief, that the stock market could be the straw that breaks the camel's back, and they're just not going to allow the stock market to break the camel's back here. And this market they continue to push this market and support this market through the different types of intervention that the plunge protection team does. And so we have to be aware of that, and just be aware that when a market is manipulated like this, you can't fight it. Like I said, if the trend is up, you can't fight that, or you're going to get hurt. You can see, I did some analysis here, a decision point analysis off this prior swing high here. Gives us another level of resistance. And we've just come into the lower end of that. If I put some more analysis, some major analysis on the chart here, you see we also had a little ABC pattern here with the minimum wave C beginning around, this is the Dow weekly chart, by the way. That's right around the 12,280 area there. And then look at the typical wave C on the weekly. Starts just shy of 14,000, I think, or almost just at 14,000 in the Dow. Okay. Now the other thing I showed you last week is, so we're either in that, looking at that pattern, or we've got wave 1 down here to the March lows. We've come up here into this wave 2 or B, big area here of resistance. You can see back here we've got this level of supply back in here, and we're into this whole area here. So we don't know which way it's going to go, of course. If the market continues to be propped up, that doesn't mean we can't have corrections and things, but overall, so far they've kept the market from being the straw that breaks the camel's back. Because I think if the market does do what it probably should do on its own without any manipulation, then it surely would be that straw that breaks the camel's back. But it looks like they're not going to allow for that at this point. So it is what it is, and you just have to play it accordingly. And if their game is, as Greenspan said, to keep their market up because it's going to do more to stimulate the economy than anything else that they can do, then the danger in the long run is, at some point when everything catches up, that there will be whatever corrections or crashes there would have been will probably be more severe because of all the intervention in the long run. And that's kind of the danger of doing what they're doing. It's uncharted territory. Anyway, let's just take a look at, if we can, if I can bring this up here, let's just look at oil. That's one that we were following as well. Because oil, we had that 5-wave pattern up here, and it has come now into that typical wave 5 area. I can put a decision point off this prior high here, and it has taken out that decision point area into this typical wave 5 area. Okay, the maximum wave 5 area is above 92 up here. So we'll see if oil pauses in here and consolidates, or perhaps gets a pullback. If this is truly going to be the end of trend, or if they're going to make a run maybe for this 92 area or above the maximum wave 5 area before we get a pullback in oil. You can see the trend obviously is still long there. Alright, so stay on your toes. Still got earnings coming out. We got a lot of this, the bigger news out of the way here last week, and we'll see what the market does here. But no sense in fighting it, but just be aware of what's going on underneath. That's keeping things moving in the upward direction here. Alright, hope that helps, and we'll do it again next week.